Hi, everyone. Welcome to our webinar today, which is entitled Preparing Your Business for Sale or Investment. My name is Philippa Batting, and I have the privilege of being the Managing Director of Buckinghamshire Business First, and we provide support for Buckinghamshire businesses as the growth hub for the county. Selling a business or preparing it for external investment is a huge moment for any business founder, and the process is bound to be full of obstacles and challenges. Strategies need to be well thought out, and it's always helpful to get as much advice along the way as you can from those who know. So today's webinar, we hope, will provide you with valuable knowledge and insights, and will help equip you with the tools and understanding to navigate this process of securing funding or achieving a successful sale. So my contribution today is to act as question master, and I have a few questions prepared, but if any other questions come up as we go along, please feel free to put them in the chat, and we'll either address them as we go if time allows, or we'll pick them up at the end of the session. Failing that, we will ensure that we get responses back to you within the next couple of days. So without further ado, let me introduce you to the panel for this event. So panelists, if you could say who you are, what you do, and your thoughts on the current environment that you're operating in at the moment. So Nick, can I go to you first?
Hi, thanks, Philippa. Hi, everyone on the call and watching us on the recording. I guess how can I help? Well, I'm an active angel investor, so I review and invest in companies all the time. I have a portfolio of about 30 at any one time. Lots of growth opportunities, funding and exit experiences from that. I run my own businesses and so face some of the problems that we'll be talking about myself. I have an advisory firm called Forge that advises people and shares my experience and some of the challenges we're going to talk about today. And also linked to our county, I chair and own a corporate events and branding company called Chameleon that's based in the region. So hopefully I can help on one or any of those counts. What's the market like at the moment? Well, always changing. When I look at my I sit on quite a few boards as well as some fast growth companies. When I talk to them and what I see they're facing is it's quite stark. You've got a few winners and a lot of people that are struggling for all the reasons that anyone who looks at the press will know. And then you have to decide whether it's not always about being a unicorn. Sometimes it's about being a cockroach and making sure you survive until the sun comes out again. So I guess I'm mixing my metaphors. So maybe it should be a caterpillar until the sun comes out again and you can become a butterfly. But it's picking the right strategies for the right time, and whether that's actually focusing on growth or it's focusing on preserving cash. It's all about reading the market, looking at the opportunities and risks, and acting accordingly.
Thank you, Nick. Gavin.
Good morning, everybody. Gavin from Seymour Taylor. Obviously, accountants. I specialise in corporate and personal taxes. In terms of what we're seeing at the moment, obviously, you've seen interest rates go up. Obviously, this webinar is very pertinent to that. It does give you the option of looking for sale or investment. Can you get potentially a better investment elsewhere? So, yeah.
Thank you. And Mark.
Good morning, everyone. Thanks for joining the webinar. I work for a firm of accountants. We're in the same network as Seymour Taylor. I am a corporate finance specialist, so my role is predominantly helping people to buy and sell businesses and to value companies. We're Essex-based. I've been at the firm for nearly 20 years, focusing on corporate finance activities for the last 6 years, heading up the department for 4 years. So our firm, Seymour Taylor, we're part of the MGI network, where we're like-minded firms working with small and medium-sized businesses to help them look for their exits and other solutions. In terms of how I see the market at the moment, I would say that It's challenging. There's certainly a cool off in the last 12 months from what I've seen. If I go back 18 months ago, before the interest rises started coming, there was a lot of investment into the M&A sector, and exit routes were probably more variable than they are today. That said, there is still lots of money available out there. There's lots of trade buyers that are looking for opportunities. So with the right advisors and the right support, I think that an exit via a sale or seeking investment is still very much achievable. But as with anything, as Philip has said, ensuring that you've got the right planning, the right approach is vitally important to make sure that you follow the right steps and end up with a result that you're happy with.
Thank you, Mark. Gavin, can I come back to you now for the first question? So a little bit of context, really. What are the options open to business founders to exit a business?
I suppose an important question initially when you form the business is part of your exit strategy. What are you intending to do? Is that to kind of grow the business and then sell it? Or do you just want to kind of create the business, let it come to a natural end? Is there a succession plan in place? So is there an intention there to pass that on to children? So there's various things here. You could obviously look to sell the shares in the company. You could look to sell the trade and assets. You could look to potentially transfer the shareholding to children or a family member. As I mentioned earlier, succession there. Importantly, I mean, one option as well that most people forget about is to simply do nothing. You could continue on your merry way and then get to the end and wind up the company. But obviously, if you go down that route, you're always going to have that thought in the back of your mind of, what if I would have put my company up for sale? How much could I have got to it for it, rather than what I actually ended up disposing of it for?
Right, so that puts us in the right frame of mind and where our thinking should be right from the very start when we set up our businesses. Mark, could you come in and talk to us a little bit about how a business is valued?
So in terms of valuing a business, the answer is it depends. If you put 100 different individuals like me that value businesses on a day-to-day basis into a room together and ask them to value the same business, you'll get 100 different answers. However, you'll have a convergence around a broad consensus of value. The reason why it's a broad approach and you would get different answers is because every seller has a different view on the value of their business and what they would be prepared to sell it for. And every buyer or investor has a different view on that business itself, its strengths and its weaknesses. So although you would get a variable outcome, it's important to understand that there are some recognized methodologies available to people like me that would value businesses, and for people like Nick who look to invest into businesses. So if I split the question into two parts and talk about what I would call a mature business and what I would call a startup business. So in respect of a mature business, typically what you would look to base your valuation on is its profitability. So a guide of the past profitability of the business will give you an indication of what profits it may make going forward. When looking to acquire a business, someone who is looking to acquire those shares is buying the ability to generate that profit going forward. So you would take the profit of a company and you would assess whether that is achievable going forward. So you may adjust for things like proprietary items. So if a particular owner or shareholder of a business is taking their earnings via dividends as opposed to a salary, post a sale, it's likely that that person would need to be replaced with a full salary as opposed to dividends, which don't go towards the profitability of the company. You may also adjust for one-off exceptional items. So that's particularly pertinent at the moment, whereby if you're looking in the recent history, many businesses have been impacted severely by COVID. So they may have up and down results that may not be a true reflection of what true profitability going forward is. Once you arrive at this adjusted profit metric, what you typically do is then look to say, for this industry, is there a particular multiple of that profit that is typical that we might pay? And that would be based around things like barriers to entry, the specific factors for that company in terms of the strength of its contracts, its management team. Typically at the moment, I'm seeing a multiple of around 6 times as an average for small and medium-sized businesses. I'm seeing some as low as 1 and 2. If the business is, got particular challenges to it, but I've done a transaction with a multiple as high as 30 times. I would say 30 times is very much the norm, very much the extraordinary. And as I say, 6 is about the average for sort of small, medium-sized businesses. I think that creates a enterprise value. So that's the value in which the trade of the business is worth. Additionally, in a company, you may have built up some assets over a period of time that you haven't drawn out for tax purposes, and it would be right in a sale process that the seller would expect to be able to extract those that value and those assets from the business. And we call those surplus assets. Similarly speaking, if you built your business by taking on some debt and there's some external liabilities there, it would be fair for a buyer to expect that those liabilities are paid by the seller on completion of the transaction. So we take our enterprise value and then we may adjust it for a surplus asset or a net debt adjustment, and that arrives at our equity value, i.e. the value at which you may sell the business. There's lots of other ways in which you might value a business. There's discounted cash flows, venture capitalist methods. There's valuing it based on its net assets. But broadly, for most scenarios, you value it on that basis. If we're looking at a startup very quickly, what you may look to do is then look at a different metric as opposed to profitability, because you may be in an early stage of that process. So you may look at annual recurring revenues if it's a software type tech-based company, or if you've got high future growth potential, you may look at that future cash flow that you're expecting from that growth potential and discount that value of the cash back in today's value. Probably the last thing to say is that if you're looking for a partial exit, then a incoming investor may look to apply a discount onto the value of shares. So if you're selling, for example, 25% of the share capital, you wouldn't necessarily expect to receive 25% of the value of the business. You would expect a minority discount to reduce that value down to reflect that the incoming investor doesn't have full control over the company.
Thank you, Mark. Nick, would you have anything to add from an investor lens in terms of valuing a business?
I mean, like anything, every transaction is unique, and it involves a lot of things that are soft as well as hard, and there's quite a journey to go through. But I think that's a good starting point, and I guess on some of the other questions we'll get through some of those other parts of the journey.
Okay, thank you. So, Nick, if I come to you now, then, in terms of when is it the right time to seek investment into your business?
Well, I mean, a bit like that first question about, when should you, how should you look at your lifetime of your investment? I guess probably the advice I'd give is always try and get your business at a state where if an offer came in or if someone wanted to invest, you are ready to accept it, because most of the disciplines, 90% of the activity you need to be ready for investment or choosing the right time are just about running your business well, and it just gets you into good habits. So I think as a mindset, I'd always advise just try and be ready, and that's one of the I do a talk that looks at a checklist of how you can get a successful business, raise money and sell businesses, and that's got 24 points on it. So I call it the 888 checklist because it's in 3 different parts. So the right time usually is before you need it, because these things often take time. You have to get your team around you, the right advisors, people you trust. Hopefully you've got them on standby anyway, but quite often you haven't got everyone you need as part of that team. And time is your enemy. So if you start running out of time in terms of you're running out of cash, or there's an opportunity you need to seize, you're on the back foot, and it takes longer than you think. So typically a round with an angel group or a professional investor should take about 9 months, and you see so many investors or so many people looking for investment and they think it could take them 3 months. Hardly ever does. So 9 months, I guess, is the minimum I'd suggest, certainly for seeking investment. For sale, it can take from 2 months to never, and the vast majority is never. So the odds are against you. And I guess, why should you seek investment? It's back to that yin and yang. It's either for the good reasons that you see lots of growth opportunities on the table that you actually haven't got the bandwidth or the capital to take advantage of it, and that's one set of investors you can attract and story you can tell. That's either equity or debt. You don't necessarily need to give away equity if you don't want. And the other is survival. And if it's about making sure you don't run out of cash, again, timing is so important. So I guess having all the normal disciplines in place, have a plan, have a forecast, prepare early, and realize that actually it will take longer than you think.
Nick, do you think makes a business an attractive investment?
Well, I guess all investors have their own style and their own preference, and I guess the first thing is, as someone seeking investment, I would try and spend a little bit of time trying to look at the company through the potential investor's eyes, and then you can try and figure out what looks good and what looks bad. Come clean quickly with what looks bad, because the main thing that kills a deal is a lack of trust and transparency. So you almost want to do your own audit first to understand where your weak points are and bring them to the fore quite quickly. And if it's early enough, try and solve them before you go to investors. And also look what the particular bias is, or ask the particular investor what's important to them, because you won't know all the synergy values or the reason why they might want to invest, and you don't know necessarily what their hot button is. But for me, I've got a sort of 6M process that I use. So I look at the market, how attractive that is. I look at the management, because any investment is in people, which can be an issue if you're looking to exit, because if someone's wanting to invest in you and you don't want to be around, then there's some debates about how that works. Then it's about the business model, what you're buying. Is it about the trading performance, or is there some IP in there that you want? Momentum is always important. So any investors looking at what's the traction, is the business doing well at the moment, how's the business trading while I'm in the negotiations about buying it or taking an equity stake. Finally, money, about valuation, and I guess the other one is, the last M is me. So as an investor, I have a particular things I like. I also have a portfolio of investments, so I'm trying to figure out how this new investment would fit into that portfolio. I might want more fast growth. I might want a steady eddy. I might want it at a certain stage. I might want a certain type of valuation. So in some ways, as a firm, you can't do much about that, but you should try and flush that out from your investors to see whether it's a match. I really get to the problems quick, because otherwise you can waste a lot of time, both on the investor's side and the company's side. So again, it's trying to have a data room ready, respond to questions quickly, a bit like dating, really.
Nicely put. Nicely put.
I think if
Um,
I just come in quickly and just, I'd
yeah.
just like to reiterate something that Nick said there. I think what I see quite often is businesses taken to market too soon, where they haven't had the right advisor-led support to get them deal fit. So I cannot stress the importance of creating the warm, fuzzy feeling between the seller and the buyer.
Mm.
If you can create that by having information to hand when the investor or the buyer asks for it, by being open and honest about the bad bits of the business, but also the really good bits about the business, I think that creates a great level of momentum, the word that Nick used, towards a successful completion. So I really do think that having your ducks in a line, and I call it being deal fit, is vitally important to a successful outcome.
Ever ready, I think, is the word that's coming through this loud and clear. So, Mark, staying with you for a minute, then, when is the right time to sell a business?
So I see all sorts of clients come across and sit across from me in meetings, and the variety of the reasons why they're looking to sell their business is quite varied. So stripping everything away, first of all, just from a personal perspective, the last 3-4 years have been very difficult in terms of the cost of living crisis, COVID, etc. So I'm seeing some business owners who are just exhausted and have got a different outlook on life, and who are perhaps looking to cash in their chips and enjoy their life. And so I don't think that those personal reasons why you may want to do it should be overlooked. The other option is you just receive an offer that's too good to be true, that you really can't afford not to achieve and accept. I had a client not so long ago who had no intention to sell. They were approached off market by what I would call a consolidator, who wanted to buy lots of similar businesses, combine them up into one big business to create synergies. And the multiple that I spoke about earlier in terms of the valuation was 14 times, which is in that sector very abnormal. And the offer was just too good to turn down. So sometimes either your personal situation or the market situation may dictate that. If it's not for one of those reasons, then it may just be the stage of life cycle that your business is in. So in terms of looking for investment into your business, as Nick said, one of the things you may get to a point where you've plateaued, where you need extra support, whether that's financial, whether that's a bit of advice about how to access new markets. Think very much the Dragon's Den type support that you may require. So if you recognize that you're getting to a point where you need extra support in the business, then looking for that investment rather than a full sale may be that first step towards that eventual exit. Other reasons why you may want to exit, and Gavin may want to come in on this point, is the tax environment. So corporate, when you sell a business, you have to pay capital gains tax. That world has potentially been sitting on a cliff edge for the last 2 or 3 years about a potential rise in capital gains tax rates. So you may want to hold on for a higher value because you think your business is going to grow in 2 years, but if the tax rate may go up by a certain percentage, you may be no better off than selling today. So I think those are probably the key factors that I would say are key to considering whether it's the right time to look to sell or look for investment.
I'll come back to you, Gavin, in a minute, if I might, in terms
Indeed.
of those tax. Mark, just staying with you for a second, how can you find the right buyer for your business? What are the hints and tips?
So the right buyer ultimately is someone that you have trust with. As Nick said, these transactions, whether it's an investment or a sale, can take a significant amount of time. You need to find that there's a partner that's sensible, pragmatic, and willing to come to the table to negotiate when you get into the detail. So as you go through the process of looking for that solution, whether that's a full exit or investment, identifying the right buyer is really important. And the right buyer sometimes is the one who's offering the most amount of money. Sometimes it's the one that offers the best package for the individual client's needs. I think the most important thing, as we've already touched on, is having the right advice and the right team of advisors around you. If you are looking to exit the business and that's a sale to a third party, sometimes you may know who that third party is. Other times you don't. So having an advisor that has access to various platforms, their own black books of potential buyers is really important, because it accesses parts of the market that you as a seller may not be aware of. So you can open doors, whether that's internationally or just into different areas of the UK, whether that's vertical or horizontal in terms of your supply chain and your customers. There's lots of different ways in which you can approach identifying a number of buyers that would be interested. Finding that right buyer is then a case of identifying what is it that you really want from your exit. Are you looking just to take your money, walk away into the sunset, buy some cars and a nice yacht and forget about the business? Is it that you want to hand the business over to someone who's going to ensure it continues in the same way, with the same ethos that you've built perhaps in a family business over many years? So understanding what your buyer's triggers are, what they're looking to achieve by acquiring that business is important. So you look at it from that other lens as well. So you put all of these factors into the melting pot, and you effectively, how I work with my clients is you identify probably 10 or 20 potential buyers that you would go to market and say, here's the information about my company, here's some detailed financials for you to go away and let me know if you're interested in acquiring that business. And in that process, typically, if they're interested, they may want to come in and have a look at the business premises and how it operates, may want to talk to you as an owner, and that allows you to build up that rapport so that you're able to really get a feel for, is that the right buyer for you? But I think it really comes back down to just understanding your own business, understanding how the market for that business looks, working with the right advisor in advance of when you think you are going to be ready to be looking for a buyer or an exit or an investor, and then working closely with that advisor to help to achieve your aims and objectives.
Thank you.
I mean, you go to the gym before you run a marathon, hopefully. So I guess it's the same analogy. Go to the gym first and do get prepared for a marathon, and hopefully you'll get to the finishing line. But again, I don't want to give optimism bias. The odds are against us. So when you look at some stats, 40% of businesses make it to the 5th year, 20% to 10 years. Most businesses for sale do not get bought. So how do you make sure? The two most important variables are luck and timing, but how do you make sure luck and timing is on your side and you're around long enough and you spot the opportunities? So finding you've won if you found a buyer. Let's make sure that we understand how hard it is. And also the odds are highly likely it's a trade buyer. It's someone who knows you, and often it helps if they've done business with you or partnered with you or have a relationship over a few years. So there's less likelihood of things happening during the process that will disrupt it. You read in the press all these PE buy-ups, roll-ups, EIS investments, etc., or exits, but be aware that the odds are against you. So you have to really get to the gym. You have to be match fit, and usually the person who's going to buy you is closer than you think. But it's good, as Mark said, to do that scan and have a number of options, because the one thing that can make sure a deal happens is competitive tension. So there's usually some wobbles along the way, but if if there's a plan B and the buyer knows there's a plan B, it can keep them on the straight and narrow.
Keep them focused. Staying with you, Nick, realistically, what percentage and involvement do angel investors look for when they're looking at a business?
Well, again, every angel has their own incentive. Most tend to be older. Most tend to be male, although that is changing now. But there is a demographic there. A lot of them tend to be quite financially savvy, so they will pore over the spreadsheets. Some will want to get involved in things they just enjoy, and they want to help companies grow. So they're usually looking at earlier stage, and they'll want to take advantage of SEIS or EIS tax breaks. So if you're not offering, if you're not in a position to offer that, you're at a disadvantage when you're looking at the angel community. A few are looking at turnarounds or MBOs, but the vast majority are looking at SEIS and EIS because it gives them a hedge for if the investment doesn't work, and they get some tax breaks as a result. Experienced angels will usually look to be part of a cohort of investors that they know. So it will be more than one of them coming along, which again helps both sides. And they will usually want someone on the board or an investor director who can help guide the company, but also give them some indication of how the company's doing. And ideally, you would want the angel to be prepared for multiple funding rounds. So it wouldn't be a one-hit wonder. It would be a relationship that builds, and actually they can invest again in the future. That can also link to a phased buyout as well if you're looking to exit. So again, these things are not always one-off transactions, hence why it's worth keeping the relationships good on both sides. But yeah, different angels want different things, but usually they want to get involved in something they know about, something they have a passion for. They will want to get to know the founder and the team, so they will want some human connection, and potentially they'll want someone on the board having some oversight. But when I'm advising founders or looking at, I'm saying, what sort of angels do you want? And usually there's two counts. You want someone who either is willing to add value, has enthusiasm, brings something to the table, but doesn't necessarily mind if you don't take their advice. Because you have some who are frustrated CEOs who actually want to tell you how to run your business, and you don't want people like that. It's your business, you're running it. The other sort of angels that are good are ones that are low maintenance. So maybe they don't require that much looking after or information, and they don't seek to add that much value, but at least they're supportive. So you either want low maintenance or engaged, but not precious about you not taking their advice. What you don't want is people who want to tell you how to run your business and maybe haven't got the insight or the strategic background that would support that.
Good advice, Nick. Mark, can I come to you? How does a business founder maximize the value of their business for a business sale?
So I think it comes back to some of the themes that we've spoken about before. So ultimately, if a investor or a buyer of your business has a warm, fuzzy feeling around your business, they're more likely to pay more and overlook potential areas where the business isn't perhaps as strong as it could be. So whether that's a weak management team or something like that, they may be able to look around those things. I think there are some practical steps before you even go to market where you can actually maximize your value without even looking at how you're going to exit your business, which is to ensure that you've got your structure of the business right. So looking at your shareholdings, ensuring that, for example, if you're family-owned business, that in the lead out to a potential exit, you've got shares distributed around the family so that each party can benefit from the business asset disposal relief of tax, which is at 10% rather than 20%. So that's just a way in which you could have the same deal value, but achieve a greater actual value of cash in your pocket at the end of a transaction. So you shouldn't overlook those initial planning steps. I think in the build up to a potential exit, the things we've spoken about in terms of making sure that you've got a good management team, good financial reporting structure, good systems and processes. You don't have any over reliance on any particular individual, or as far as possible, that owner manager reliance is reduced. All of those things help to create a better value proposition for an incoming buyer or investor. I think the other things that you would look to do is to ensure that, as Nick says, you've got that competitive tension in a transaction. If you are responding to an off-market approach that says, we'd like to buy your business, and this is the offer we're going to make for you, how do you know that that is the best offer out in the market without actually going out to the market and testing it? So someone like myself, I could have a look at that offer and say, it's reasonable in the context of what I've seen, but until you've actually deep dived and gone to that competitive process, you don't necessarily know that there's not another buyer out there that's going to push that price up. I think the other things that you can do in terms of looking at how you maximize your business value is actually looking at the deal structure itself. So if, as I said before, your intention is just to cash in, walk off into the sunset and not look back at the business, get all your cash on day one, then you're likely going to have to accept a lower value transaction than perhaps if you're prepared to hang around for 2 or 3 years post-transaction, or if you're prepared to put some of the consideration into either deferred terms or what I would call an earn-out, which is where your future income from the transaction is based on the profitability that's achieved after the transaction. And I think that's a really important way when we're talking about potential investment and a sale of a high growth company, because it's all well and good saying my company is going to grow by 100% each year for the next 5 years, therefore it's worth 20 times multiple, etc., etc. An incoming investor or a buyer is going to challenge that and say, is that really achievable? So the bridge between those 2 points of view is quite often considering this earn-out potential, so that you get access to that growth, that if you hit those targets, then of course we'll pay you that increased overall consideration value. Those things comes with risks, and as I've said before, having the right advisors on board to make sure that those risks are mitigated. Earn-outs are probably the most disputed item of a transaction, because there's always misinterpretation about what each party thought at the time and what actually happens post-transaction. So ensuring that you've got a good legal team, a good set of advisors that can advise you of the potential risks, so that you can be informed in the way in which you agree that final transaction. Probably the last thing I would say is just make sure that you don't jump any steps in the actual process, that you actually take the time to have a look at heads of terms in a real level of detail, for example, because you may get to a point where if you haven't done that, you get to the point where you're negotiating the detail of the actual legal transaction, and you're kind of so far down that journey that if something turns up that the buyer says, I don't want to pay for this reason, I didn't realize that there was this in the business, or there was this as part of the transaction that you wanted, you may be too far down that transaction where you almost feel obliged to accept a lower position than what you thought you might be. So identifying at the heads of term stage all of those specific items of detail for example, how a debt-like item might be treated in the calculation of surplus assets is really important, because it allows you to know exactly what you're getting in for ahead of actually doing the deal. And that allows you to negotiate from a stronger understanding of what you actually are going to achieve from that transaction.
I've got a real example of where that happened when I was on the board of a company that happened too. So that's great advice. Mark, can I just add also, I mean, in terms of value, it's some of the what seems superficial things are important. And I guess I see this more with my sort of comedian branding and events business. I don't know about you, but when I buy a book, sometimes it's just because it's a nice cover, and you need to have a nice cover on your business. So making sure your social media is up to date, making sure that your branding is consistent everywhere, because you can guarantee people are going to be Googling you and looking for proxies of, is this a well-run business and is it vibrant and modern? So getting all that house in order, I think, is really important. I mean, in some ways it's superficial, but in other ways it really gives a good indication to people about, is this something I want to be involved in? Is it something I'm excited by? Also as your employee brand. And also making sure that the management team understand the culture and share the values and share the vision for the future. So you can do that by having some offsites and some events, etc. Because if you start to get different stories from different people you're dealing with, again, that really undermines some of the value. And you're saying, well, actually, is this a coherent team? Is it just one person spinning me a story? So some of these other things about your branding, your marketing, have you got the team aligned? Is there a strong culture? All these things are really important before and during a process.
Thank you. Really, really useful information there. Gavin, can I come to you to talk about the nitty-gritty tax and the personal finance issues attached to selling a business or taking investment?
Yeah, of course. So I suppose the first thing to mention, as Mark alluded to earlier, is at the moment, the tax system is as it is. On an annual basis, we go through the budget. We also have coming up, most likely, going to be a general election of some kind. So again, we could see the kind of future of capital taxes changing in the not so distant future. So just kind of going back to the points earlier in terms of what are the options, if you were to do nothing, ultimately you're going to go through that process of liquidating the company. And as Mark alluded to, you could be entitled to what's known as business asset disposal relief, whereby ultimately the first £1 million worth of the gain is actually taxed at 10%. The remainder taxed at 20%. So if we were to consider a company with reserves of, I don't know, say 1.5 million, you'd be looking at capital gains tax of 200,000, leaving you with net proceeds of 1.3 million. Now, a further consideration there is you've just realised an asset for 1.3 million, and that now forms part of your estate for inheritance tax. So ultimately, at the moment, you've kind of got an inheritance tax nil rate band of £1 million between yourself and your spouse. That's not to say as well, on top of that, you've got other assets, property, cash, and so on and so forth. So you've immediately there potentially crystallized a bit of an inheritance tax problem. So again, going back to, I think the common theme here is getting advice, professional advice early on is so important. The second option that I mentioned earlier is actually passing the asset down to a family member. Now, again, it's kind of not really a topic for discussion today, but if you were to do that, you could be entitled to what's known as business property relief, whereby the entirety of that shareholding is ultimately IHT free. So again, it doesn't increase the value of your estate and helps pass down value to the next generation. Now, the concern there is that your children may not actually be interested in running that company, which is the reason why ultimately you end up selling that company, and the likes of Nick come along and come in, invest, and take over that company. Just kind of moving back to actually selling the shareholding in the company, again, business asset disposal relief should be available. As I mentioned earlier, the limit is £1 million, but one thing that you will need to consider is whether you've made any BADR claims in the past. Let's say you're a serial entrepreneur and you've already claimed that £1 million allowance, then you can't claim it again, I'm afraid. Previously, the limit was 10 million. When business asset disposal relief was kind of rebranded, they reduced it down to 1 million. So again, keeping on top of the kind of tax structure and the tax system is vitally important, but it shouldn't necessarily drive the transaction. There's no harm in, I mean, let's say your business is valued at 1 million under one set of tax rules, but 2 million under a different set of tax rules. If the 2 million one is at a higher rate of tax, then you could still end up with more in terms of net proceeds. So it shouldn't ultimately be the driver. An alternative, again, is in terms of the sale of the assets of the business. So as Nick alluded to earlier, you might have one piece within that business that you perceive the value to be there. Often that's in intellectual property. So, I mean, not necessarily a point for discussion today, but something further down the line. I suppose the final kind of alternative is what would be either a management takeover or an employee ownership trust. So what you might look at there is actually selling the company to the employees of the business. And that kind of gets over that issue of kind of succession that we discussed earlier. If you're in a position whereby you could set up an ownership trust, then you'd obviously need to obtain a professional valuation, which clearly Mark can help there. It's then a case of structuring the agreement and raising third-party capital. And again, that's potentially where the difficulty arises at the moment. Following that, it's a case of implementing the scheme itself and, if necessary, obtaining what's known as HMRC clearance. I suppose if you were to consider an employee ownership trust, then probably one of the most famous ones out there is actually John Lewis, which is owned by over 80,000 employees.
Thank you. And staying with you, Gavin, for a minute. So you've done sort of tax and personal finance issues, but legal and contractual issues, what would be your headliners on that?
I mean, obviously, I would firstly recommend speaking to a solicitor. But I mean, just kind of looking at the things that we've come across in the past, you've kind of got initially your commercial contracts. So do you have formal contracts in place with customers and suppliers? Will they need to be amended? Who's named on all of those contracts? Is it the company, or is there any form of personal guarantee by the director shareholder that would ultimately be leaving that organization? Do you use standard terms and conditions for sale and purchase? And I mean, just touching on something that Nick mentioned earlier in terms of your social media, is your website legally compliant as well? In addition to that, when you kind of put your business up for sale, there may be kind of other assets within that agreement. So you could have an operating premises from which you operate. Again, can you evidence your kind of legal title to that building? I mean, you should have all of these things in place, but it's that kind of due diligence piece that Mark alluded to earlier of, have you got all of your ducks in a line kind of thing to make sure that the kind of sale process is as straightforward as possible? Again, have you got any leases or licenses that are coming up for renewal? If you lease the premises, is there an issue with the landlord? Will the landlord just simply allow a new owner of that business to be able to take that over? So I suppose there's a few issues there in terms of property. As Nick alluded to earlier, employees, probably the most important thing when you're looking at buying a business is the employees. Does every member of staff have a contract of employment? are those contracts reviewed on a regular basis? Are performance reviews conducted with all employees? Is there a staff handbook? I mean, there's a lot of things there in terms of employees that you should be taking separate legal advice on. I mean, again, coming back to intellectual property, something that could be worth a huge amount in the future. I mean, if the company does own IP, how valuable is that IP? And has it been registered? Are all the necessary assignments and kind of licenses there already in place? Because ultimately, if you've got IP and it isn't protected, then ultimately it might not be worth the paper that it's written on. And again, just touching back to employees, does an employee have a right over that IP? Because they were the person who initially started that piece of work. In terms of the shareholding as well, you've got a few issues here. Are the shares held in the most tax efficient manner? I mean, for the majority of owner managed businesses, the shareholding is kind of structured in a way that it's split between yourself and your spouse, simply for tax purposes. Does the company on the sale of the shares need to alter its articles of association as well? Something so simple, you kind of think, oh, I mean, we should just be able to sell the shares. Not necessarily. Again, you're going to have to, as part of that due diligence process, the purchaser will be looking at the articles. In addition to that, is there a shareholders agreement in place? So if you've got multiple shareholders, or I mean, we've mainly focused on companies today, but if you're in, say, a partnership, an unincorporated partnership, is there a partnership agreement in place? I suppose the final thing to mention that's kind of not necessarily related to shares, but are there any actual charges in place over company assets as well? Something that you can quite easily see for yourselves on Companies House. I suppose the final thing to touch on as well is the immediate taking over of that business. And for what would be for most people, their concern is, am I going to get paid the next day? So banking, how difficult is it going to be to get everything transferred over into the new owner's name? Because, I mean, it's something that you consider to be so simple, but has anyone gone into the bank recently and asked for assistance and got a response that same day or within a week? So I suppose there's a question there in terms of key banking documents, and touching back on Mark's point or earlier in terms of, if you are looking to sell that business, are there any debts that the company has? So a loan, for example, that should be repaid on the sale. So again, you may need to consult the bank at that point in time as well.
Thank you, Gavin.
Classic, Gavin, I can add in there is, has everyone got all the software passwords for running payroll or accessing the bank? I've had that where suddenly no one knew how to actually pay salaries on the day they were due.
All the nitty gritty things. But I think you said earlier, Nick, it's you should always be in a state of readiness. This is good practice anyway in any business to have this.
Yeah, I mean, you get a headache if you just list them all out now. You get a headache. You think, oh my god! But ideally, this is things you're working on all the time anyway.
Yeah,
so it's not a big shock to the system.
Yeah, even if you're not thinking of selling now or getting investment now, it's good practice. So, finally, Mark, can I come to you in terms of how much is it all likely to cost?
That's hopefully not the $1 million question, but the reality is, if you're selling your business, it is going to be one of the biggest professional decisions you'll have in your lifetime. And therefore, surrounding yourself with a team of trusted advisors is highly recommended. And that doesn't necessarily come cheaply. So typically you'd have an accountant, a corporate finance advisor, and a solicitor, lawyer working on the transaction. And those fees can run into tens of thousands of pounds, if not hundreds of thousands of pounds, depending on the size of the transaction. It's difficult to give a ballpark. If you're using a corporate finance advisor to go to market to find you a buyer or to find you an investor, then they typically work on a percentage basis of the value of the transaction or investment that they bring into the business. Those percentages can be from sort of 2 to 5%, sometimes a little bit lower, sometimes a little bit higher, depending on exactly what you agree. And then legal fees kind of depends on where you are in the country to a certain extent, what size of firm you use. But yeah, they can run into, as I say, tens of thousands of pounds. But I'm sure I would say this, being an advisor, I think getting that right advice is vitally important, because you only get to do it once. And if you get it wrong, the consequences can far outweigh what might seem like a large fee at the outset. You do find advisors that are happy to roll over fees and bits and pieces if the deal doesn't go through, and work on success basis, etc. But typically it's not a cheap process. And if your transaction is, say below £1 million, it's difficult to find that relevant advice at a cost-effective rate compared to the value of the transaction. So you have to work around and find an appropriate advisor in those situations.
Thank you.
I mean, I'd also add, cost, as you're the business, you do need to spend time on it. So you do need to be taken out of the business to focus on it. And therefore there's a cost of keeping the business going and people focusing just on the business delivering its numbers, as well as running a transaction in parallel. So hopefully you have a Ned or someone in the business that can help share that load, and you have operators that can help keep focusing on the business while the founder or the person doing the deal is taken away from it. And Mark, one thing I'd add, I don't know if you agree, but ideally what I try and do is you tend to agree a what you think would be a decent value of the transaction, but you want to incentivize your corporate advisor to try and get you above that. So therefore you might want to do a tier percentage. So you can agree a basic percentage on a certain amount, but then add an incentive if you get a better outcome.
Yeah, exactly.
Is that fair?
Yeah, exactly.
Thank you.
So you're happy, you don't resent it because it's win-win on both sides.
So I'm conscious of time. It's 10:58 and we're due to finish at 11. Elton, I can see that you've put a call into a question into chat, which is hopefully, as we've gone along, I think there's been a lot of relevant information from the panelists, but we will undertake to get something back to you formally after the webinar in terms of that question. So 10:59, it just leaves to me to say thank you very much, panelists. I think it's been a really informative session with lots and lots of figures and statistics and things that will just put people on the right track. So thank you very much for participating and giving up your precious time. Thank you.